This week's commentary is going to go over why the one thing we all have, especially these days, is the one thing we don't need to be a successful investor. So what is this thing that we all have but is not going to be helpful to our investing success? I'm not going to make you wait around 20 minutes like the news does. The answer is your feelings. And I care about your feelings, but the markets do not care about your feelings. Markets are ruthless, they're cold, which is why there's the old adage that the markets will do whatever is going to hurt the most people. I don't know that I'm quite that cynical, but I do believe in the caution that comes along with that old adage. And so to that end, I wanted to talk through feelings because I'm having a lot of conversations, and I welcome those conversations. But where people's plans are getting often confused with how they are feeling about things, and that's where, again, we can get ourselves into trouble. So I'm going to talk about some of the big feelings that are out there and give you maybe a little bit more information before you decide to act on those feelings. Feeling number one, hey, I think we're good. The market's going to go back to all the all-time highs. Maybe we should think about buying some more stocks. To those people, I would caution you that this would be the first bear market where we've never seen at least a little bit of a retesting. Again, market movements tend to look more like a W than a V. Anything's possible, but when you look at how the financials have been acting, financial stocks, bank stocks have been very dire over the last few weeks. They would tell you we're probably not out of the woods. Companies are pulling guidance, which is understandable on the one hand, but most of the analysts that I work with would tell you that when a company pulls guidance because they don't know what's going to happen, that's really code for we do know what's going to happen and it's going to be nasty. We just don't want to tell you yet. You also have a Fed funds rate that for 1 year out is now pricing in negative interest rates for the Fed funds. None of those things really tell you that can say there's an all clear and should be moving into stocks with heavy new money. That being said, while the Goldman Sachs of the world, among many analysts, do believe we probably get a midsummer swoon, most of them still think we finish the year somewhere at or slightly above these levels. So again, take that as both a caution to not be too bullish, but also not to be too bearish. The second feeling I'm hearing so much about these days is, hey, why don't we just buy the S&P 500? Why don't we just buy, in particular, the FANG stocks and go home? Here's why. Nothing stays on top forever. The last time you had 5 stocks making up 20% of the total S&P market cap valuation, and the same time you had growth stocks outperforming value stocks at this level, was 2000. I know for a lot of people, they believe in the notion this time is different. I don't. We'll touch on both probability and this time is different in a little bit. Of course, things never look quite the same, but their mean reversion to me, again, is one of the most powerful truths that I've come to understand about markets. If you look back at 2000 and the 5 names that made up 20% of the market cap, there were incredibly powerful narratives. They're all companies that are still in business. This isn't pets.com, but it wasn't necessarily a great entry point to buy those stocks. What were the 5 stocks? GE, Intel, Walmart, Cisco, and Microsoft. Arguably an even more diversified set of 5 stocks than the FANG stocks today, which are all tech. What did those stocks go on to do over the next 20 years? Well, GE is still down 90%. Cisco is still down 23%. Intel has only averaged 1% a year annualized return from then, but took 17 years to get back to even. Walmart took back 10 years to sustainably get back above its break-even point. And Microsoft, the only name that is in common between the 20 years ago top 5 and today's top 5, and I can hear some of you saying, well, that's it, that's the answer, it's the obvious one. That took 16 years to get back to even. It's had a spectacular last 4 years, but 16 years. And I think if we're all honest with ourselves, holding on to a loser for 16 years with the belief that the next 4 will be the 4 would be a very difficult, and statistics would tell you almost impossible reality for the majority of us. The third feeling I want to talk about are kind of the twin cousins of, hey, this time is different, or next time I'll act different. Here's a hint. It's not, and you won't. None of us do. We need to have plans and processes. Those feelings are deeply ingrained in us, and those reactions to certain things are not the kind of thoughtful responses that we want to have. For a lot of people, again, they said, man, I knew that this time felt different. It just felt like a different pullback. The reality is every 5, 10, maybe even 20% pullback feels like the beginning of something really, really ominous. The reality is less than 20% of them actually do become that thing. Why we believe statistically that they are is that they so vividly imprint on our psyches and our memories. And if you read Thinking Fast and Slow, the book I talk about all the time by Daniel Kahneman, he'll tell you just that your probability weighting or your remembrance of how often this happens is heavily skewed by the emotional impact that it had on you. So we want to be very careful of that. Similarly, those people like, I'll buy the next dip. I wish I would have got in last time or added a little bit more, but I'll get the next one. Buying low sucks. Like, you're never going to enjoy buying low. The next time it's down, there's going to be some really scary stuff going on. There's going to be something that drove it down that you could use to justify, again, why you think it's going to go lower and not buy. It's got to be more process oriented. Set those levels in advance. Have those fundamental, technical, quantitative, historical reasons for why you will move at certain levels and stick to it. But I'll wrap up on this. How you can do all that, knowing that you can and will be wrong, is through two lenses. Number one, if you act with what's most probable most of the time, you're going to be okay. Number two is having a plan that understands that probable, again, is not 100%. And so your game plan has to come with the understanding that you're going to have times and or periods where you're just flat out wrong. How are you going to get through those periods? It's not as simple as just buying the FANG stocks. It's not just as simple as going back and buying all the dips in hindsight. You've got to have a plan, and this is where real money management comes in, that presupposes I'm going to be wrong a fair amount of the time. How am I going to get myself and others through those? That's why for those of you who are retired and listening to this, or have friends who are about to be retired, we laid out those 4 points earlier of having a defined income stream, having those emergency buckets of money, having our reallocation plan to capture upside set in advance, and understanding where we can find long-term dividend growth. That's having a plan that doesn't take into account market timing, doesn't take into account having to buy into it this time. It's different philosophy. And it's why, again, so many of you can rest assured that these types of periods, as uncomfortable as they are not permanent, nor are they fatal. So in closing, we absolutely care and want sincerely to discuss how you're feeling about life itself, how you're feeling about your portfolio, how you're feeling about the markets. That is absolutely our job. Studies show behavioral finance is a big component to long-term success. We just want to help you and be the partner to you that helps you put you on the most probable path and build a plan that doesn't have to be based off perfection. That's our goal. For those of you who are walking that journey with us, thank you as always. For those of you who might want to sit down and chat, virtually or otherwise right now, we're here for you as well. Hope you have a wonderful weekend. Thanks so much.